All right. Good afternoon, everyone, and welcome. I am very excited to help present today's deep dive into the reinsurance world and introduce our guest from Guy Carpenter, who will be walking us through various aspects of the reinsurance market. My name is Andrew Harris, and I'm the current second vice president for PIA of New Jersey, and also the president of Liberty Insurance Associates in Millstone Township, New Jersey. As a officer at PIA, I sit over the Business Issues Committee, and part of the mission of that particular committee is to bring timely and relevant issues to bear. So as such, we have created this deep dive series, which allows us to educate our members and kind of broaden the understanding of topics like this one. So the topic of reinsurance has been coming up a lot more over the last year or so, and I'm sure if any one of you have had conversations with any of the corporate leaders at our carriers, you've probably heard plenty about it. Our goal with this presentation today is to sort of demystify the topic a little bit and make it easier for everyone to understand and explain the market forces driving premiums and tighten underwriting restrictions and things of that nature. I'm sure most of the people on this call understand the basics of the reinsurance process and, from a fundamental level. But what we believe in talking in the committee is that there's a lacking of that deeper understanding of the market forces and what the carriers are experiencing on an average basis, and even tougher for their circumstances with carriers with some riskier portfolios, coastal markets, things like that. So we're going to talk a little bit about the structure and various methods the carriers use to cede risks to the reinsurers at the beginning. I do want to just touch base real quick and make sure everyone understands that while those first few slides are a little bit basic, I assure you it gets a lot more involved in a hurry. So don't, log off if you think it's too basic. So later on in the discussion, we're going to dive into the market conditions and those capacity issues that everyone's hearing about, and exactly what that means with some actual numbers and statistics, and some of the modeling used to predict some of the losses and what they're going to be, and what's driving the decisions and impacting agents and our customers. So if you have any questions as we're going through this, please enter them in the chat box. We're going to try to address them as they come up, or we might decide to, based on what it is, handle that at the Q&A session toward the end there. So without further ado, I'd like to introduce our speaker today. Our guest today serves in two roles as a P&C treaty broker and also as deputy leader of Centers of Excellence and Client Experience with Guy Carpenter. With over 23 years experience in the industry segment and Guy Carpenter, her client work spans casualty, property, and financial lines, as well as client portfolio that includes a number of large mutual companies. She holds a bachelor's degree in risk management and economics from Temple University's Fox School of Business, and has an MBA from NYU Langone's part-time program, as well as having an associate in reinsurance designation. She's born and raised in the Philadelphia area and currently resides in Summit, New Jersey, with her husband and two sons. I'm very confident she's going to do a great job and be engaging as we go through this process. So please help me welcome Jennifer PIANJ from Guy Carpenter.
Thank you, Andrew. Thanks, everyone, for joining for this deep dive series. Very excited to be a part of it. As Andrew mentioned, we'll be talking about reinsurance today, and I will try and speed through any basic slides. I thought there were some really great questions that were posted in advance of this session, but please let the questions come on in. I'm happy to answer anything on the fly as needed. So just to give you a little roadmap for today's discussion, talking about what is reinsurance, functions of and parties to these agreements, different types and forms, and then talk about the cost, the premiums, and then also give you a little bit on the market conditions. I think that's what prompted the escalated conversations over the past year that maybe spurred this specific topic selection. So I'll be sure to touch on that and what happened at 1/1, which is one of the toughest markets we've had in years. So just to get started on what is reinsurance. So basically, reinsurance is, as we say, insurance for insurance companies. So while a commercial customer that you might have buys insurance, insurance companies also buy reinsurance on their overall portfolio, and they might do so for a variety of different reasons. So what I want to focus on is using this schematic because it helps really bring to life, the chain of how the business is transacted. So you might have retail clients. All of the participants on today's call might live in this space. We have insurance companies here, and then where Guy Carpenter, my employer, lives is right here, reinsurance brokers. So where we seek capacity or reinsurance for our clients, which are insurance companies, we would go to either reinsurance companies or some alternative capital markets. And then believe it or not, it doesn't just stop there. We even have reinsurance for reinsurers, which is retrocession, and we do have some retrocessionaires. So on the right side, the bigger part of this slide, we have a few examples of each different point in the chain. So there are different brokers. Actually, this should be updated to Gallagher Re. I'll make a note of that. But there's a lot of different reinsurance brokers in the space. You might have also heard of Howden Tiger, which is the newest combination and the fourth largest reinsurance broker that would be behind Aon, Guy Carpenter, and Gallagher. Lockton, BMS, those are other examples. In terms of reinsurance companies, and we'll get into this, these are a couple of examples: Swiss Re, Everest, and Lloyd's. So we'll talk about those in greater detail. So in terms of what is the difference between insurance and reinsurance, I think the key parties involved that I showed on the prior slide kind of makes the biggest distinction in the chain. But where the similarities are in this overlap would be, it provides risk protection, transferring of risk, there's payment of premium, and it is subject to regulation. But where there are many differences is while it could be locally sourced on an insurance side, it might be global on the reinsurance side. There's much less regulation on reinsurance. I do not need a license to be a reinsurance broker. Reinsurance underwriters do not need to be licensed, but obviously the insurance side is very different. There also is no state-by-state regulation on the reinsurance side versus the insurance side of things, where things are at the state level. And then the biggest difference, and while there's a little bit of exceptions to this, generally insurance would be on the individual risk, while in reinsurance, we mostly are talking about a whole portfolio, so the whole book of business that a carrier might have. So why do carriers buy reinsurance, and what purpose does it serve? These are the four main reasons, and I like to look at this one, this catastrophe one. It's kind of the biggest. It's a tangible example that I can think of, which is it protects a carrier from a large scale occurrence or event. So if a hurricane happened, an earthquake, a big tornado or hailstorm, and they have many claims across their entire portfolio, that's where reinsurance would come into play. So that's a huge driver of reinsurance buying. The other would be for capacity. If a risk needs to be quite large, you want to offer 50 million in limit, you might buy reinsurance so that your net line, the carrier's net line, is not that 50, but maybe something less, 5, 10 million, and then you can reinsure the rest. So it enables, you say like, well, why wouldn't you just syndicate and buy all the layers? And many insurers can participate on a tower. I think a lot of it is about efficiency. So that commercial customer could buy their policy limit with one carrier, 50 million in limit, 25, whatever it is. And then that carrier then handles the back end, the reinsurance buying. So capacity is one example, as I mentioned, but stability is another. And I wanted to go to this detailed page to really give you this nice illustrative example of how reinsurance affects carriers' results. So this red line is the gross combined ratio, so the losses and expenses over premium for the carriers. And then the green line is after they have paid for reinsurance, but also made recoveries under their reinsurance treaties. And you can see how that green line is a lot smoother. And, yes, there might be costs associated with reinsurance, but oftentimes it kind of avoids these peaks, these bad years. So instead of a 135, it'd be more like a 117. So you can kind of minimize these combined ratios, but it also minimizes the good years, right? So instead of having a 58, it might have been at a 72 or something like that in this year of an example. So just kind of smooth this line across. It obviously comes at a cost, but it really is tremendously helpful in years of heavy losses. Gave the catastrophe example already, and then the final one is financing. What we really mean by that is capital relief. So how can we support an insurance company's capital structure by offering them reinsurance. And this often comes into play, especially with rating agencies. So AM Best, Demotech, S&P, Fitch, Moody's, if they're doing their credit rating for an insurance company, oftentimes having a stronger capital base will help with that, achieving their rating goals. And so the reinsurance can help with that. Obviously, those rating agencies also look at operating performance as well. So they go back to this in terms of the stability. So a lot of companies want to achieve that smooth operating performance, and so reinsurance will help them do that. So rating agencies are keenly interested in the reinsurance buying practices of carriers. So parties involved, so who buys the reinsurance? It would be traditional insurance carriers. This can be admitted carriers, it could be E&S companies, but we also could have risk retention groups, captives, MGAs, and really MGAs that plus insurtechs, that whole space overall is becoming a much larger piece of our overall business at our firm. And then reinsurers, as I said, can also buy reinsurance, which would be called retrocession. And then sovereign entities or any municipalities. So that could mean any kind of government body. It could mean like the California Earthquake Authority, the CEA, Florida Hurricane Cat Fund, entities like that. Also residual markets like Louisiana wind pool or the North Carolina wind pool, examples like that. And then who sells it? Reinsurance companies, other insurers, Lloyd's of London, and then capital markets, as I mentioned. So to get it, there's always this like tree, and it spreads out in terms of all the level of detail from a reinsurance standpoint. But there's reinsurers that could be broker markets, which is who Guy Carpenter and others would access, or there could be direct markets where, a Liberty Mutual as a carrier might buy their reinsurance direct from a reinsurer. But I'll get into this in a second. There are many reinsurers that participate on these placements, so you need a mixture of both of these groups. Now, I made a little note here because you see Munich and Swiss on both sides of this, and that's because these are huge markets overall, and they have two distribution channels that they use. So they get production from us as brokers, but they also produce business directly with clients. So as of year-end 2021, AM Best has not published their year-end 2022 list yet, but this is a list of reinsurers. They sort it by life and non-life combined, or the non-life only. So most of my presentation has somewhat of a focus on property and casualty. So I'll just look over here on this basis, the gross and net premiums here in terms of largest reinsurers. So Munich and Swiss, as I said, largest reinsurers. Hanover Re, the German reinsurer, is here as third, SCOR, and then Berkshire Hathaway, which obviously comes in many different forms. It is Gen Re, it's National Indemnity, but now also it's RSUI and other carriers. So it's quite a combination there. And then Lloyd's includes many syndicates and so on and so forth. So you can see some of these largest reinsurers here. Just a quick word on Lloyd's. I won't go down a long trail, but Lloyd's is a marketplace. I'll use this picture to talk to it, but Lloyd's is a huge marketplace, a building in London, 1 Lime Street, where the underwriters sit at these desks, these terminals, and the inside desks are for the kind of technical assistance. The outside desks are for the lead underwriters. Brokers like myself, they do have to be licensed in London. They will go up to what's called a box, these desks, a box. So Beasley Syndicate is the example here. And they will broke a carrier's portfolio. So if I'm placing the Liberty Mutual Property Cat program, I would queue up at the desk here, the box, and I would sit down with the lead underwriter and I would go through the submission for that program and walk them through it, and then they take it away and they provide their quotes, and then a kind of conversation falls from there. And while post-COVID things have become a bit more virtual and a bit more electronic, there still is a lot of face-to-face negotiations and broking that happens in London. They actually added these signs only in the past, I'll say, decade. I did spend a few months there as part of a training program in the early 2000s, and you kind of needed a bit of a map to figure out where everyone was. You couldn't tell the difference from one box to another, but luckily they've added these signs, which makes it a little bit easier to navigate around. So I think one of the questions was, there was a reference to who is the reinsurer on a program and how do we find this out? But I just want to take a step back to say, how many reinsurers do we typically engage on the reinsurance contract? And the answer is it varies, but it could be one or it could be 30 or even more. It really depends on the program, how much capacity you need. There's a variety of factors. But just if I'm speaking generally, if I'm thinking about a large panel for a property catastrophe treaty or program, a typical panel might be 10 to 30 reinsurers. And the breakdown might be, 3 to 5 domestic or US reinsurers. So that would be like an Odyssey Re, a Trans Re, examples like that. And then Safety National, EMC, EMC exited reinsurance, so Safety National is another one. Then Bermuda, it could be 3 to 10 reinsurers in Bermuda. And then London, same thing. Those could be Lloyd's syndicates or they could be London companies. And then we have a couple of European reinsurers. So you can see how all of this adds up quite quickly, and you can get quite a large panel. And that's really necessary because sometimes we're placing $500 million, $1 billion in limit for property catastrophe reinsurance. And you really need to spread that out across many reinsurers. Now, other types of reinsurance programs that we might place would be something like a multi-line where, the carrier offers, package policy, they offer property, they casualty, they kind of bundle things together, and they cede that from a reinsurance standpoint on a per risk basis. And in that case, the panels might be smaller, maybe 2 to 10 overall, but maybe the median is more like 2 to 5 reinsurers. Now, I will get into this in a second, but the facultative reinsurance is a different type of reinsurance. It's similar to insurance, where it's a certificate for an individual risk, like an individual consumer. So more akin to insurance policies. And in that case, most times there's just one facultative reinsurer on that risk. So then the question might be like, how do you make a decision about which reinsurers you're partnering with, right? And that happens, there's a lot of different points along the process when we're placing it, where you make a number of decisions about your trading partners. And honestly, this is quite a hot topic right now because our clients are looking to make the best possible decisions about their trading partners. So a few examples are here. So decision one, I have a property cat program that I want to buy on, Liberty Mutual or Progressive. Who do I approach? So I might make that decision based on the reinsurer's financials, what kind of capacity they have, what their expertise is, what their market share is. And then I send out my submission, right? My broker sends out my submission. Decision two, well, who are we going to ask for a quote versus who am I only going to approach as a following market? And we have this quote follow approach where, a reinsurer that's willing to offer a bigger share and put a price out, they might be called a lead or quoting market. And then once we establish a price later down in the process, we have following markets that fill in capacity and they just follow whatever the price was offered if they can agree to it. So who do we ask to quote? Well, again, we get market share, expertise, history on the program. People that have been supporting the program for a long time might want an opportunity to quote it and opine on the price, and then what their capacity and appetite might be. So the next point in the process is we look at all the quotes. We've received all these different quotes from our reinsurers, and we need to identify what we call a firm order, which is a price that we believe will clear the market for the desired capacity. So say I need 500 million in catastrophe limit, I need to find a price that I'm going to be able to secure all 500 million of that limit from a variety of reinsurers. So, what is my price that's going to bring all those markets to the table? And, you're going to have this range of quotes. It's $1 to $5. Is $2.50 the right price, $2.50, or is it $2 or $4? And the answer is, it depends, right? It could mean who has quoted, that influences your decision. How many quotes do you have? How wide is the range? Sometimes it can be really, really hard to establish what that firm order price is. And that is one of the hardest things that came up at 1/1 during the renewal season, is we just had very little price discovery, very few quotes. Made it really tough for buyers of reinsurance to figure out, well, like, what will my market clearing price be? And that was one of the biggest topics of conversation. A specific stat I can offer you is at 1/1/22 versus 1/1/23. 1/1/23, we only had 40% of the quotes that we had at 1/1/22. So if we had 100 quotes at 1/1/22, we only had 40 at 1/1/23. I mean, that's just like so difficult to make decisions when you're only at 40% of your number from the prior year. And 100 is just an example. We have, thousands of quotes that we get layer by layer and market by market. So then one of the many final decisions that you might make, and there are more decisions along the process, is, so which reinsurers support other reinsurance treaties for that client? And then, because who are you going to sign shares to? And if you're oversubscribed, how are you going to make the decision about what those final signings are? And the goal for many carriers is to have a reinsurer support them across many lines of business. Why? Well, maybe you buy your property cat program, but you also buy some casualty reinsurance. Maybe your property program got hit by a hurricane this year, but your casualty program is doing quite well. You want to kind of smooth the experience for that reinsurer, so they're not punitively kind of having these knee-jerk reactions on one program and then not being able to benefit on the other side. It helps. Again, it's kind of more about stability more than anything else. There was another question about how do we see what reinsurance is purchased and who the reinsurance partners are. The answer is you can kind of find that out with the right research tools, the right data subscriptions, and a little effort. So I have two examples here from AM Best reports. So this was for New Jersey manufacturers. They have a little blurb in their AM Best report about what type of reinsurance they buy, their cat reinsurance. This is like, if you had a subscription, you could see this. Progressive was another example. They give a little reinsurance summary, but it's prose, right? You're not getting a lot of specific detail layer by layer, pricing, anything like that. They just give some general information from a risk management standpoint. And then in terms of partners, AM Best used to say at the bottom of this reinsurance summary, they'd say like significant partners are Munich, Swiss, and Hanover, or whatever they were. I noticed that recently they've stopped doing that, but that information is available in financial sources like S&L. The other source you can get for reinsurance information, this is where the little effort comes in, is in earnings call transcripts. So for public companies, in their earnings calls out in Q1 or year end, they'll talk about their 1/1 results. And they'll say, well, reinsurance market was a lot harder, so we paid an increased price and we had to raise our attachment point, whatever. They'll give a little bit of information about reinsurance in those earnings calls. So there's no like one source, there's no clean way to discern, but there's often some public information either by news article or by some of these research tools where you can get that information. So, back to a few basics and to orient you a little bit. Again, there's always these kind of decision trees, and I won't take a deep dive on this, but in terms of what are the different types of reinsurance, we have what we call pro rata, or proportional, or it can be quota share, surplus share. We have excess of loss, which can be on a per risk basis or a per occurrence, which is like an event or catastrophe. And then an aggregate, so you would add up all the losses of a year, and then the reinsurance would apply on that basis. And then facultative applies on that pro rata and XOL structure as well. So we can just skip that. I already explained, but for facultative, like why would you buy facultative versus why would you buy treaty? So facultative is coverage for a specific policy, for a specific consumer within the portfolio. And the reinsurance is based on the usage, it's custom to that specific policy, and often offers a substantial amount of risk per risk coverage. And oftentimes it might be used in conjunction with a treaty, like, hey, I can give on a treaty basis, I can cover your portfolio for all risks up to 25 million. You know, each risk is a maximum of 25 million. But say you have one policy that's 40 million and you need reinsurance on that one. So you might buy 15 million of reinsurance on that one risk, and then that way everything is contained 25 million or less, and that goes to your treaty. So they can be used in conjunction with each other, or they can be used independently. And as I said, this is broader coverage. It can be very efficient on a treaty basis, and the terms often a higher commission than with facultative. So in other words, the expense and cost to buy.
Hey, Jennifer, real quick, what is ECO XPL coverage?
Sure. So ECO XPL is extra contractual obligation, or extra beyond the policy limits. So in other words, these are examples where you have a claim that a court or settlement or mediator might decide that there are additional expenses related to how you settled a claim or adjusted a claim, and you have to go beyond those costs, beyond the policy limit to pay. So even if in that example I gave, you have treaty coverage up to 25 million, maybe you buy a 15x10, but due to the claims adjustment process or the nature of the claim, maybe you have to pay 30 million. There is some ECO XPL coverage provisions you can get where the treaty can flex up to that 30 million beyond that $25 million policy limit coverage that's agreed. So that's really an expense related item. So just to level set back to our reinsurance types, I wanted to be sure you knew this is not a repeat of the slide by accident, but it is on purpose just to remind you what we have. So we've got treaty and FAC, pro rata, and XOL. So you might be thinking like, what, I need to picture this. What does this actually mean? And you'll be familiar with a lot of this in your work, but the pro rata reinsurance will be, again, it's for a whole portfolio, and you share from first dollar of loss, and you would put maybe 40% quota share. So 40% gets ceded to reinsurers, 60% gets retained by the company. So you have $10 of loss, 40 cents go, or $4 goes to the reinsurer, and $6 is retained. So the breakdown is shown here in terms of, one policy limit example, gross policy limit 500,000, what's ceded, what's held net, and then what the premium might be. So if the gross premium in this case is 12,500, what might be ceded and net, because it's just based on the proportions now. There's no real quote per se on the rate. What the quote is when you're doing quota share is a ceding commission, and the ceding commission is what reinsurers will give back on the premium to help the carrier cover their policy acquisition costs. So maybe any commissions that they might pay or any other expenses. Typically, ceding commissions are anywhere from 20 to 35, but it varies widely depending on what type of quota share reinsurance you're buying. From an XOL standpoint, this is obviously, what an XOL looks like. This example is more of a per risk example. So we've got a 500,000 x 500,000 and so on, a shared layered tower. Basically, you would know how that works. And this would, you could have this on a per risk basis, or you could have it on a catastrophe basis. And then we even do some aggregate covers on this basis. So let's jump ahead a little bit. I do want to jump to this point. When you have per risk reinsurance, this is important to know because policies are renewing throughout the year, right? But reinsurance might be effective 1/1. So what this is meant to comment on is just to let you know that some reinsurance is on what we call a risks attaching during the treaty period. So if a policy is effective 6/1, but the contract is 1/1 to 1/1, right? This risks attaching, the policy attaches to the treaty the day that it is put in place, it's in force. So this 6/1/13 policy attaches to the 1/1/13 treaty, because it was effective during the term of this treaty period. On the other hand, we might have something called losses occurring during. So we don't care when the policy is effective, as long as it's in force or renewed during the treaty term. The losses just have to occur during the treaty period. So because this loss occurred 3/15/14, it applies to the 1/1/14 to 1/1/15 treaty or reinsurance contract. So it's two different types of coverages. Typically, this losses occurring during is for catastrophe reinsurance, and the risks attaching would be more for per risk type business. So one thing I wanted to touch on is enduring reinsurance. So carriers don't just buy one reinsurance contract. They have ceded reinsurance departments in many cases, and many large teams that deal with the strategy, the financials, the administration, and the decision-making around what type of reinsurance they buy. I mean, this might be an example only for property, but they might have a whole other set of reinsurance from a casualty standpoint, and surety and marine and so on and so forth. I think Liberty was mentioned as one carrier of interest, and obviously they have an enormous portfolio, so they cover many lines of business and have a big reinsurance team. So this is just one example to give you a sense. But so when I think about my property portfolio, I think about, do I need any facultative risks, any risks that might get punched out from my treaty? I need 25 million in capacity normally, but I have my $40 million risk. That might be where facultative comes in. Or maybe there's a certain type of risk, like, oh, we can't do prem ops in the policies that are ceded to the treaty, so we might need some FAC for that coverage component or something along those lines. It could be coverage related or capacity related. Then we have our property per risk coverage, which gives each risk some protection. And then we have our cat protection, which is on the overall portfolio for large events. And then even further, a carrier might decide to buy aggregate coverage, and that would be to make sure in a year their performance is stabilized, is kind of managed to a certain level. So there's benefits to all these different reinsurances, but they all kind of have to work together. So aggregate reinsurance, all the way at the top of this chain, is based on, well, I'll price you your aggregate reinsurance, but I need to confirm and assume that you're definitely buying this cat, that you're buying this per risk, you're buying this back, and it all reduces the net exposure to my ultimate aggregate. So you start off with $1 here, you reduce it to 70 cents, you reduce it another to 50 cents. Now 50 cents is what of exposure is what gets ceded to the aggregate program, if that makes sense. So they all kind of have to work together, and the order can vary, and it applies to casualty, as the note indicates. But I think this is really just to illustrate the point that reinsurance all has to work together, and there is a lot of strategy and financial analysis and economics that go into what you buy, how much you buy, and how you handle it across your entire portfolio and various lines of business. So I wanted to talk about cost. There was mention about this in some of the questions in advance, and I touched on this a little in the structure slides, but proportional or quota share reinsurance is paid, as I said, proportional basis. So you cede 40%, you would cede 40% of the premium as well as the exposure, and then there's a ceding commission to cover those policy acquisition costs, right? Non-proportional or XOL is mostly a rated product. So you have a rate against the premium, or you charge what we call a rate online against the limit that's being purchased. So there's two different ways that we handle this. So just to give you an example, so this would be a catastrophe, say this is catastrophe reinsurance, right? You have a $1.5 million x $0.5 million layer, and then if the subject premium income, that's this SPI, say it was 20 million, and the effective rate, which is the reinsurance price, is 300,000. The rate is 1.5%, but we're buying 1.5 million in limit. It could be 300,000 again, the premium, but divided by the limit. It's two ways to express the price, that's all. It's just two different ways of how we express it. So oftentimes if you're reading in the Insurer or the Insurance Insider or any of those publications, you might hear rates were up for catastrophe reinsurance 40%. Mostly what we mean is the rate online. So it means that the 20% went up to 40% increase year over year. Mostly on catastrophe, we're talking about this rate online. When you talk about other lines like casualty, you're mostly talking about rate or ceding commission results. So I just want to clarify that because rate online is less common, commonly discussed, but that is the technical term we use from a reinsurance standpoint. The other thing that I wanted to bring up around cost is that mostly traditional catastrophe reinsurance offers what we call a reinstatement. So similar to how your policy might be split, your occurrence and your aggregate limit, the same would apply here. So in this case, we have 1.5 million in limit. You might get one reinstatement. So you get a second 1.5 million. So in other words, per occurrence, your limit would be 1.5 million in limit, and then for the aggregate, it would be 3 million. So I just want to jump ahead. One last point before going into the market conditions would be how do carriers pay for reinsurance? I think this was a question about where the cost goes. And basically there's just like a risk manager handles the risk of their firm, ERM or enterprise risk management teams handle the insurance carrier portfolio risk. And so they would transfer it by buying reinsurance. They might accept it by having a budget for catastrophe and attritional losses, or they could mitigate and avoid. So when these two transfer and accept happens, they pay it out of gross or direct premiums written. When the reinsurance costs increase, they would use rate filings. And then when reinsurance conditions become so punitive, like they did at 1/1, they might mitigate or avoid by either raising the attachment point or buying a little bit less limit if they can take that as, within their capital base, if they can support that net. So just jumping ahead a little bit to state of the market, what was happening at 1/1. So, just like the insurance market and the economy overall, these macro factors influence the reinsurance market conditions. So we had inflation. And why is inflation a factor? Well, if the auto losses are increasing in severity, then that goes to what, it costs more to fix a car, or especially, a hurricane happens, the car was in a flood zone and it is complete total. It costs more to replace that car, or even on a per risk basis. These different situations, that inflation is a huge factor from a claim standpoint, obviously. Supply chain also affects the claim costs, right? Climate change, a huge factor for catastrophe reinsurance. How might that influence, hurricanes, tornadoes, et cetera, the frequency that those events are occurring? And then the US and global cat loss activity, that's kind of somewhat related. There has been a lot more activity in the past 5 years versus 10. So that's a common thing that reinsurers are pointing to. And then constrained capacity overall. So if reinsurers can't offer the capacity that carriers need, that restricts what they can offer, and that supply can't meet the demand of the carriers. So I mentioned, what happens with pricing. This is per risk reinsurance. So pricing for good programs, meaning good experience, we're up 20 to 35%, which is a pretty steep increase. There was very little risk appetite from reinsurers to write new business. Reinsurers were less interested in lower layers, et cetera. So you get the sense, just basic economics. Supply was down, pricing was way up, limited appetite. It was just a real contraction overall. And then this fourth column that we tend to use in these slides, we have terms and conditions. We just also saw a real contraction in coverage. the same applies on a casualty basis. You see a lot of pluses here, working layer casualty up 10 to 25% and over 25 for loss impacted layers. Again, this is on the casualty side. And then the cat side, which is the splashiest, gets a lot of press, the 40 to 60% up in terms of renewal rates. And again, that's the rate on line that I talked about. And it's mentioned here. So when we talk about capacity, this is our chart. This is a little bit hard to see, so I'll just kind of rattle some of these numbers off to you. But basically, this line across is 100%, means that if you need 100% place capacity and you meet that, you're good. Anything above that is excess capacity. So oftentimes we have authorizations on our CAT programs well above 100%. This year, not so much. We were at 96%, so we were below what we needed. So we did not have enough capacity to meet the need. Why? Well, not only did continuing markets reduce their capacity, but there was a lot of exits. So AXIS, still a reinsurer and obviously still an insurer, but AXIS exited the property reinsurance. Everest reduced their property cat book as well. Tokyo Marine Kiln reduced their property or their reinsurance overall. TransRe began to do a lot of cat reductions as well. SCORE and XL, but also similar. So some of these are partial reductions, some of these are full exits. EMC should be on here as a full exit from the reinsurance space. All of these companies continuing on in other ways, insurance or casualty reinsurance, but just the property cat space saw a real contraction. I mentioned cat losses, catastrophe losses, and this is the trends that were putting a lot of pressure on the reinsurance pricing. So you can kind of see over a 10-year period what the total number of natural catastrophe losses were, and the breakdown of the stacked bar chart is by quarter, but you can see how there's this big increase in the past few years. And this is only 9 months through 2022, but Ian obviously came into play. And then in December, we had Winter Storm Elliott over Christmas, which is actually starting to creep into reinsurance programs as people get a better handle on losses from that event. So a lot of natural catastrophe losses flowing through the insurance and then into the reinsurance space, which was also putting pressure on price. So we do have some meteorologists in our firm, and there's a lot of conversation about this peril that we broadly call severe convective storm, but what it means is tornado, hail, and straight line wind events, derechos, things like that. And we just see, this is this area of the country, North Central, you can see this huge spike in economic loss in recent years, driven by these types of tornadoes, straight line winds, hail events, severe convective storms. Here, put another way, again, we call this SDS, but tornadoes, hail events, straight line wind events, you see this huge dramatic growth in losses. And that's due to a lot of things, right? Population density, construction, things of that nature. So that contributes to it, but there is a change in terms of the frequency that we're seeing these events come into play for insurers and reinsurers. And the one thing I will add on the cat side that you probably also saw in the press was this increase in what we call attachment points, basically deductibles of the XOL programs. And we saw a huge increase, a 45% average retention increase in terms of dollars, which was huge for carriers to take. So what that means is a lot of that risk now is being retained by a carrier, and they have to fund that in case the loss event happens within the retention. So it's a big risk that carriers are taking.
I actually have a quick anecdote on that point. I was talking to the CEO of one of our carriers, and he was explaining their increasing costs, their increased attachment point, and then also the cost for that recapitalization, I believe, whatever the name of that was.
Reinstatement, yeah.
He was explaining the Elliott winter storm. Had that happened 2 weeks later, the difference in their net loss would have been something in the range of $100 million. So it kind of really highlights what it is that you're talking about. So
It's such a great point. Thanks for bringing that up. That's very, very true. So again, losses occurring during, remembering that little schematic and timeline, as Elliott occurred in December of 22. For the 1/1/2023 contracts, those attachment points increased. Had Elliott happened, 2 weeks later, it would have happened against a higher attachment point, and that loss likely would have been more retained by the carriers. Not to mention the fact that they already are, paying more in premium, and they have to pay for the reinstatement premium to reinstate the limit. So there's a lot of costs that went into those. Just, what was it, December 21st to the 25th is when the winter storm occurred. So just a few days different, it would have had a dramatically different impact on carriers. So we're at 150. Check in, Andrew. Keep going. Want me to stop?
Yeah, I think we can keep going. There's a couple of things I think we can get to. And
okay. So this is Guy Carpenter's Rate Online Index. Again, back to how we price cat reinsurance, the rate online, which is premium divided by limit placed. And you can see from 22 to 23, look at this dramatic spike here. So overall, the US rate online increased 31%. And you might be checking me right now and saying, wait a second, a couple of pages ago, you told me it was 40 to 60%. What we mean by that is risk adjusted. So we're accounting for the fact that these layers may have shifted upwards and they're higher, in other words, more removed from the exposure. So when we account for that, that's kind of where we get these. Risk adjusted is 40 to 60, rate online is 31%. So that's the difference, it's shifted upwards. A couple of different small dynamics, but you might encounter this in your policy negotiations with your insurers. They might be cracking down on some of these different issues, but terrorism was a huge issue at 1/1. It typically was included in property cat programs, and it kind of carried along since 9/11, but there was a lot more restriction for terror at 1/1, and then same for what we call SRCC, or strike, riot, and civil commotion. There was a major push on both of these top two items for a complete exclusion, and the results were a mixed bag. Some were able to get some level of terror protection or some level of SRCC, but many had to exclude it or restrict it in some way. So that was a very common coverage issue. The last thing I'll point out is loss occurrence definition. What do we mean by that? There actually are hours clauses in reinsurance contracts that say what the coverage is. Like a hurricane can occur for 120 hours or 96 hours. So in other words, what is that, 4 days? We have these different parameters which different perils can occur. There was some attempt to restrict that in some way, reducing, again, from non-hurricane wind events from 120 down to 96 or 72 hours, which is just an attempt by the reinsurers to contain or reduce the loss that would be subject to the treaty. They weren't really too successful in that effort, but it certainly was a pressure point at 1/1. So that's the main body of the presentation. The rest is some supplemental information, which I think would take us down a long rabbit hole. So I can kind of pause there and see if there's maybe any other questions, or, we are able to share the slides per the request.
Yeah, I think this is a good place. The rest of it has to do a little bit more with some of the modeling and how they kind of develop their speculative weather-related patterns. So one of the questions we got was, how do I explain this to my client, which is, I think, probably what we're all trying to figure out at this point. So I think just knowing more about it, I don't know if, it depends on the client probably too. I mean, there's some people I can talk to them blue in the face about carriers are going to lose money and that might lose their AM Best thing. And I think that's really what the overall thing is, to just help understand that the carriers are doing this balancing act of, creating profit and bottom line profit to their shareholders, but also maintaining their AM Best rating, not pushing too hard to lose customers and market share. And then there's all these other things that are going into it. So it's definitely a lot that they're handling right now. So
Yeah, I think they're doing it for financial strength and being, as you know, insurance and reinsurers, their goal is to be in business for a long time, to trade over the long term, right? So they don't want to be out of business next year. They're doing all they can to protect that capital and maintain that stability over a long period of time. And by maintaining ratings, by maintaining strong capital, by maintaining strong operating performance, they're able to do that. And reinsurance enables them to write more business. So without reinsurance, you'd need that many more carriers, and they might be popping up and disappearing year to year based on this huge swing in volatility of their results. Whereas with reinsurance, they're able to be smoother, stay in business longer. So it helps the overall balance of the insurance market.
And please, everyone that's online, if you have any questions or want clarification on anything, feel free to put it in the chat box. Again, this is being recorded, and we're going to send the slide presentation out. But while we have Jennifer here, I think it's a really great asset to have somebody that understands it at the degree that she does. So feel free to pop those out. Brad, were there any other questions that came through?
Nope, that was it for right now. I can give everybody a minute if they want to add anything in. But
So basically, the whole takeaway I got when going through all these different things is basically it's a giant supply and demand issue, just like any other product. And that's how I'm trying to explain it to my clients. And that, you know, just because we don't have a physical product like a car manufacturer might, that doesn't mean that we're not affected by the same supply and demand pressures. And as we discussed with inflation and everything else, that the demand is still up, if not higher, and the supply is way down, the demand is way up. So it's there's only one place left to go, which is increase deductibles or increase pricing, and that's really all they have left to do. There's not a whole lot of levers left to throw. So
yeah, and the people on this call are the experts, the true experts on the underlying business. But you know, it is common now for reinsurers and reinsurance brokers, for that matter, to start digging into the weeds. Like, why are we seeing this increased frequency or this increased severity? Wow, well, the chip manufacturer, supply demand, you know, that affects, you know, the ability to repair a car, to replace a car, or home, like labor costs and construction costs, construction materials. That all those increases are multiplied when you're thinking about it at a portfolio level rather than an individual risk level. So it really starts to escalate a lot of these major issues. Fraud in Florida, obviously, regulatory issues are huge topics as well. So it all gets magnified when you think about it at the portfolio level.
that's actually one of the questions just popped up, is what are we expecting from the Florida renewals, which is, I'm sure, something we could talk about for the next hour. But
yeah, like big increases in price, obviously, of course, but they actually did experience some increases already last year, in June 1, 2022. So Florida renewals are mostly effective June 1. That's the starting date of wind season. So that's all happening right now. It's in play. Capacity is getting bound. I think reinsurers, I should say, not people, but reinsurers know more what they're able to offer, what their prices are, whereas at 1/1, it was still a little bit of figuring everything out. So it was very last minute, and people were more shocked at responding to it. Whereas now, I think going into the Florida renewals, people are a little bit more aware of what's happening. While they may not like it, the price change or the attachment point change or anything, they're a little bit more prepared for it. So they're going a little bit more knowledgeable. The price discovery is a little bit better. People are going out a little earlier. So still going to be the pain that we felt, but just in maybe a little bit more more symmetry of information.
I think there was one slide we might have skipped over real quick, but I think when we were meeting, there was a slide on the 2022 results of the reinsurers and their loss ratios.
Maybe this one.
It was just indicative and telling of what they're seeing and why they need to push the rates up. Yeah, you said 22 wasn't out yet. I think there was some other place, maybe another slide, but
yeah. Well, this one certainly, obviously, these cat losses have been huge. That's certainly a big impact. trying to think where else it might have been. I can certainly get one
Yeah,
for you. If we
It
don't
could have
have
just
it.
been in our prep work that we were doing, but you know,
Yeah.
it looked like the average was over 100 for sure. And
Definitely.
that's never a good place for the carriers to be. So
Yeah, I mean, I'll say this, a lot of our clients said, with this reinsurance increase on January 2nd, I'm already starting at 100% combined ratio or over 100% because my reinsurance cost is so much that I'm already starting at barely break even or losing money. So that is a major challenge that carriers face. But they have to pick, am I going to keep my rating or am I going to, sacrifice that, you know, for saving that those premium dollars. So it was, you know, obviously the rating certainly won out. The car results won out. All right.
to respect everyone's time, Brad, is there anything else? Any
Nope,
other-
I think we're all set. As Andrew, as you mentioned, after this is over, we'll send out the slides and a recording to everybody who attended.
Well, before we go, I do want to thank Jennifer. I think she did a great job walking through the ins and outs of some of this. And if there are any additional questions or if you want more information, I'm sure we can work with them and PIA to get more of that distributed. Like Brad said, this was recorded, so please encourage other people to watch it and understand it. And if any of you can think of any other issues that are timely and becoming an issue that you think PIA might want to take on, our business issues committee will certainly explore it. If you send us a note, we'll put it on the agenda for the next thing. And finally, just a plug for PIA of New Jersey. We are constantly trying to keep up with the industry trends, issues, the government affairs, the regulatory environment, and working with our lobbyists on behalf of the independent agent community. So please consider joining PIA if you're not already a member. And also, if you are, even if not, consider donating to the New Jersey PIA PAC, which is money that we use to help with our legislative efforts in New Jersey specifically. So thank you everyone again for your time, and I hope you enjoyed the presentation. And again, thank you to Jennifer.
Thanks so much. Appreciate
Enjoy the
being
rest of your day,
invited.
everyone.
Take care.
Thanks, guys.